This is Justin Pulitzer. This is my weekend review for Sunday, May 10th. Happy Mother's Day. A lot to cover. I just want to pre-apologize that my voice, I may sound a little nasally. I've been fighting a cold all week. I'm just going to do my best here. Anyhow, we have a lot to cover, and Janet Yellen this week had made some comments here about stocks being expensive, but not so much relative to bonds. I'm going to cover that in a minute in some quite extensive detail. I did a lot of research on this over the weekend, and I have some interesting thoughts to share with you. But then we had an unemployment number that's been called quote-unquote Goldilocks, and it's been coming in with weak, on the heels really of weak durable goods orders, weak GDP information, and now we're getting a weak jobs number to confirm that the market may be free of Fed recrimination going into the summer. So we had a gap here, a hold. We did close over the prior dump days, so you took all of this back. We also closed over the Fed day and that key reversal day high, albeit slightly. But we did stop short of covering this reversal kind of doji here, which is at 12.02. We closed here, you can see, at 11.62. So we are firmly in the upper distribution that I've been discussing for a while. You can see on the volume profile, you see this spike here, this distribution. Then we sort of have this distribution in here, the next one down here. And I have infamously now demarcated these levels. And we are well above this 208.97, although we did look below it here this week. And we kind of closed just below it Thursday. 100-day moving average held. That's been the trend here on the with some closes on either side of it in this period, but roughly around there. We held here, and now we are back up. So after all of this fear and chop, we are basically back to where we started from the beginning of the week. So what do I see going forward? Now, I sort of am a little bit torn here. As you can see, even in this period here, the tops of the range were sort of sellable. And in here, every time we kind of get up into this area, it's been unsustainable and we've had corrective action. So I would say that your first sign of strength will be if we can take this high here, this 1202, and then I do think that we could re-challenge this high and then get into some of those fib extension numbers that I had discussed, which aren't really that much higher, 211.40 to 214.17. Wouldn't shock me to see to run some buy stops here, just where shorts keep their stops, and see sort of that incremental move higher like we did here. Once we broke out of range, we sort of had that, we chopped a little, no one believed it, and then we just had that sort of wash out of the shorts, and then, unfortunately, it came right back down into the middle of the range. So that's sort of the playbook that I'm thinking may happen again, actually, because it happened before, maybe it happens again. We incrementally get higher here, and then potentially come back and fill to the middle of the range, and oddly, that middle of the range would be the Fed gap fill. So what I'd be looking for here is, like I said, to take these highs for that move higher. If we're going to come back down now, you probably would see it easily below this day's low. So it's about a point in the SPY, and if we take this low, then I think we're going to come back and most likely fill the gap fairly relatively quickly. It may take a day or two, but this range now, it's not that big of a range. And I would say that it's a go with above and it's a sort of go with below, but, sort of gingerly do it. Do keep in mind we are at the top of the range. So I do think that Friday, obviously, the price action was bullish. We're here. But there are some cautionary signs that I'm seeing in the market in some of the momentum stocks. And I'm going to cover that in a little bit, particularly with Apple and Google and how that relates to the Qs. But you can see this, and also in IWM. So let's just go over those quickly. IWM did not have that type of strength. We are not in that upper kind of distribution, over the high, testing the highs in IWM. However, we are over the 120.97, but albeit sort of tentatively. We kind of were flirting below here. Friday couldn't even take out the range for the week with the gap down, and it's showing some relative weakness below the channel, below the 50-day moving average, below the 20-day, and below this sort of breakdown level. So it's a little bit cautionary. You can see it kind of stalled out here right around where this distribution picks up. So there is a little bit of overhead supply. It's not tremendous, but this is a little cautionary. I would say that the risk here, any break of these lows again, I think we're going to be looking back down into the 119.39 to 117.37 area, which I do think would be a strong right or right out buy within this area for a bounce. But, mind you, we would then be coming from lower highs, which is, for me, would be more of a trade than it would be like an investment. So that is one thing that is cautioning me. The Qs are also a little cautionary. They were stronger than IWM on Friday. We are back above this sort of regression downtrend line that informal that I drew. It did kind of get back up close to here, but we didn't take the full dump back. We're not above that last pivotal swing high here, which was the 109.42. However, we did hold the tail line of this support, which I had been discussing, the 106.25, and we never really dipped further into there. There's a lot of reference support here. You can see this 105.26, this 104.58. So Qs to me are sort of tentatively okay. We are back above the 50. We are back above the 100. We're back on trend. It's the Qs to lose, so to speak here. If it's going to be strong or if it's going to be weak, there's a little bit of indecision again. 111. What did I say this was? 111.16. Oops. Just want to really draw that downtrend channel properly. I would say a break of the downtrend here is probably going to be a go with to go higher. And that's really going to depend on, I think, Apple and Google. And I'm going to be a little bit uncharacteristic. I usually get to those later, but I'm going to do them up front here. And I really want to show you an Apple. You can see this broke the pattern here on the earnings. The previous pattern had been to go higher after a break in earnings. I'd have to go back further, but the last time, let me see if I could show you that quickly. I'm only on 6 months. That's why I usually like 9 months. You can see here the pattern was a break on earnings higher, consolidation. Here a pattern, break on earnings higher, here consolidation. Here the break failed. We are now back mid-range and sort of struggling with making lower highs and now lower lows. So I would say Apple is sort of really, really in a tentative position here. It's sort of mid-range. It's over. It did kind of break the downtrend, although be it just gingerly. It did take the 50, and it did, I believe, close just over the 20, which to me kind of gives, I guess, the bulls a little bit of optimism. But in my opinion, as long as we're below that 129.85, which was, the Dow Jones, the add to the Dow Jones Industrial Average, and below this range high, which is the 133.60, the stock still has a lot of work to do, and I think the risk is until it can take this, the risk is actually still lower, that it could go back down and retest the breakout here of this 119.75 and potentially the channel low here into the 117s at this point, where it would, I think, be a great right or right out setup buy. That may also coincide, I don't know how long it's going to take, but the 100-day MA is probably a day trade also, considering it's roughly where these lows were. And I think a lot of the problem for Apple has been the problem that has plagued most momentum stocks here, that it didn't have the full check back to retest the breakout. It rallied ahead of time, and the anchor from which it rallied wasn't, the launch pad, so to speak, from which it rallied from wasn't as strong, and that's what's led to this chop. And this had been a big problem I had discussed a lot in Tesla, if you recall from videos back. Google, on the other hand, also is really relatively weak and considerably weaker than Apple. You can see it's also in a really large range. It's sort of struggling below these levels that I've been, or I should say sandwiched right now between these levels that I had indicated as being the keys for the momentum, the 545.41 and the 553. You can see we've had a lot of resistance. It's been unsustainable, moves up there, moves into the range into the 580s, have been met with selling. Also a gap and crap on their earnings, came back down into reference areas and now is kind of struggling to kind of rebound itself. So Google, I think, is a little bit of a different story. I think they have a lot of headline risk with the EU trying to break them up, although that's now starting to filter into Apple with tax probes. So the news, always keep in mind, falls along the line of least resistance. And in this instance, the news has been terrible. So I think Google really has a lot to prove. I do think that it's going to set up for a buy somewhere probably between this 526, maybe the 513. It may even need to retest into the lows closer to the 500, where I think it would actually be a pretty decent right or right out type of a trade, just because you have so much there. But mind you, if we do come down there again, this is multiple tests. There's a big gap that starts there, and I'll show you that now. You can see there's that big gap that starts here, and if we start losing that again, it could want to come down and fill the gap and to have a primary trend line touch, which would coincide here. That to me would be the absolute place to go heavy right or right out long in size, either via selling out of the money puts or buying shares. But right now I think it's really, again, just going to be kind of a slave to the market a little bit in terms of catching its breath and consolidation. This stock had run a real lot a while back, and it's just been in this, working off consolidation phase, which is really what the market has been doing since 2013, I believe. A lot of working off from that excess that it had shown. The VIX is hovering around its sort of lows here, where it's been able to kind of find support and rally, and we're just sort of like in this meandering phase. It is possible we are in some type of a situation like this where we're just going to have low volatility for a time until we don't. But in my opinion, until the VIX can take this 1720, which were these double tops, I think the market is kind of still quote-unquote BTD, meaning buy the dips. If we can take out that level, I do think we'll see some type of an IV spike somewhere into the 20s and possibly into the mid-20s. But I would be very careful here. This is a great idea to buy some protection, like puts on the S&P to hedge longs, or to start lightening up on longs into rallies, which is sort of my thesis. If you remember what I talked about with SPY, that you sort of want to play the range, so to speak, buy the dips, sell the rips, or look for that type of fib extension to really kind of lighten your positions into. TLT has been sort of breaking down here. I've been looking for some type of a measured move down to like close to this 117, which also coincides with channel low. However, we didn't do that yet. We sort of broke trend. We broke this prior swing low. We broke this like tertiary trend line, the 200, and then we sort of checked back but didn't close very strong on Friday. So this may want to roll over a bit more again. I did a fib extension. The 113.37 is a 1.618 fib from this move. There's also the 1.272, which is 118.75. And the measured move from like this, if you took this move from here to here, roughly takes you to the 117. So I think somewhere in this pocket is going to find some price stability, and you can see we kind of rallied a little bit ahead of there on this 50% fib, and then there's the 61.8 roughly in here. So I think somewhere in these teens is going to support for quite some time, and we'll probably just chop there, assuming some type of a rollover. We may wind up doing something like breaking back into the pattern and trying to fill this gap here up to the close to the 127s, which was sort of this peak, and also a downtrend in the 50. So just keep an eye on this with the TLT. I'm looking for some type of a right or right out play for a long down here, preferably against like a bottoming tail hammer on one day, either to have good location that day, like maybe a small buy, and then a buy over the next day's high of day for like some type of a move up down in here. Or for really if I had my druthers, what I would like better is for this to move up sharply up into here and to set up for a right or right out short. that to me would be the better play. If you are playing the short, anything below this 122.97, I think it's still okay. Anything above, gets a little bit more iffy. This swing low, which was a island reversal pattern, a 2-day reversal, a break of that is pretty bearish, but the break needs to hold, quote unquote, and it is sort of holding here because we kind of looked back above it, there was some memory, and we failed, so just keep that in mind. I would say that Friday's range is key. Anything below there is a short, really. Anything above is probably a long up to here. But I'm really looking more to short this on rallies than I am to buy it on dips. There is such thing as a zero bound, and that is very key. So that covers up most of the indices. And I want to discuss something with you guys that's a little bit more big picture at the moment. And that is what Janet Yellen was talking about, and her saying she thought the market was expensive, but not as expensive as bonds. And this prompted me to kind of put on my thinking cap and to look back and see what she was talking about. And I did a little chart here, and I came up with the PE ratios of the stock market in the S&P before big crashes, and I juxtaposed that against the 10-year Treasury yields at the time leading into the crashes. You can see a couple of caveats. I was having a hard time finding the 10-year yield for this, so I just used the Fed Funds interbank rate, and that was roughly about 6%. So this is probably somewhere between 5.5% to 6%. I will do a little bit more work, and if I could find that, or if any of you know that, please let me know. I'll update it. So one thing that was, and another thing, the PE ratio in 2001 here actually exceeded that of 1999. The market did go higher into 2000, mostly chopped for the entire year of 2000, first 6 months of 2000, and then it really started breaking. And likely this PE ratio went up just because the market wasn't going down fast enough to catch up with the decline in earnings. But what Janet Yellen was saying is this, is that yes, we are a little bit expensive in terms of the market PE ratio. It's currently about 20.68. The historically accepted average is roughly 15. That's sort of the mean. And when you start getting into single digits in like crash corrections, anywhere below 10, 9, 7, or wherever you can get, that's usually the time to buy the market in size for the rebound. And anytime you get over 20, I don't have the chart up here, but I did some historical looks, and anything above 20 really does start to get a little bit unsustainable. But here is the kicker. That is in a normalized world with interest rates that are normal, which are somewhere between 6% and like 4 or 5%. That's usually when the Fed, when the yields get expensive enough that people decide that they want to take off their risk, that they're no longer willing to pay these multiples for earnings, and they take the market down huge. But here's the caveat. We are nowhere near that level in terms of the interest rates. We are at a 10-year rate of 2.14%. That is insane. I mean, it's pretty low. And to be truthful, the market does deserve to trade at a higher than normal multiple because we are at a lower than normal 10-year yield. So a couple of things can happen here. One, that this multiple will expand and we will go higher, probably getting close to challenging the 1929 and the 1929 and 1999 multiples, or this level here, the discount rate, I should say the interest rates need to come up considerably to get closer to these 5%, which have triggered these sort of panic corrections and crashes in the past. Which one of those is going to happen, I'm not sure. This goes now back to the game of sort of chicken that the market has been playing with the Fed. And the Fed, to me, based on the data, should be actually doing more QE or easing based on the data that's come in. You have a durable goods number that was actually negative if you factor out airplanes. It was slightly negative. There was some bearishness in aerospace, but in general, durable goods are coming in weak. GDP is now at stall speed, almost going negative, and that was signaled by the Atlanta Fed. And you also don't have really super duper robust employment numbers. Fridays, like I said, was sort of the Goldilocks number. But the big problem is the labor participation rate and the quality of jobs. It seems that the American dream has now become to be waiters, bartenders, and construction workers, because that's the only area that seems to be showing any growth in the service and construction area. And you have a participation rate. I had that written down. It actually ticked down slightly, so that means it got there was actually a slight improvement, but it's like around 62%, between 62 and 63%, which means that nearly 40% of the country is not working. That is not very healthy. That's the lowest it's been since I was born. That's 36 years of labor participation rate being junky. So let's keep that in mind. There's one thing I want to show you. If you do take the SPY, and I don't want to get too wonky on you, if you do go, let's say we're going on a weekly, and you do decide to adjust the S&P 500 price to a 15 multiple, that would roughly take the market down about close to 26%, which would, believe it or not, take you down close to here, which was the breakout of the all-time high of 2007 pre-crash. That would be a pretty large dump in the S&P 500. It would be about almost 55 SPY points, and it would take that multiple 15 us back to 15, which is here. Now, if that does happen, the chances are that it might not stop there, and it may do something like overcorrect and go much, much lower. But that would be if I would think if interest rates start to normalize a little bit more, or if there's some type of a credit contraction. I'm sorry this is all junky up here, but the price of the market is up here, and that would bring us back down to here. So that would be sort of a normalization of multiple with a reversion to the mean. I do believe that at some point, I don't know when, we will retest this number. It could be 5 years from now, it could be 2 years from now, it could be sooner than that, but it does seem like we would probably retest there. You can see this was the high. We broke out. There was a little bit of a check back here, but we've never really re-challenged it again. It's possible at some point we will re-challenge that. We have been in this predominant up channel. We are actually above that. So all systems are sort of go at the moment. But like I said, we are starting to note some weakness in leaders like an Apple or in a Google, and in other indices like biotech, and in some of those leaders which had been really market leaders, which are now sort of holding us back a bit. And let's go through some of that. The IBB is sort of rolling over. We made lower highs here. We're now making slightly lower lows, although we did hold the 100-day moving average. And we are now kind of retesting the backside of this up channel within a bigger up channel. So we may have a little bit more correction to go here if we can't get back above. I would be a little bit cautious until we break the downtrend. It is possible we do break up here. There is some news like Biogen, I believe, is doing some type of a buyback. Excuse me. And those stocks started to turn a lot on Friday. We are back now above this last swing high of the range. So price is starting to turn a little bit. If this does wind up doing something rolling back over, I do think that there would be some price memory somewhere around these highs, and then the channel low, the predominant channel low, which I would be a buyer in size for right or right out type of a play. You can see in Biogen, this is now, I had discussed this at the time that this was sort of looking like a blow off top. It is now coming back in. We didn't fully fill the gap here, which I really would have liked to have seen for a right or right out play right down to the 353s. Instead, we rallied a bit ahead of time, but we haven't broken the downtrend yet, so it's sort of still wait and see. I still like this for put ratios for some type of a move down here, although since we did bounce ahead of it, it may want to do something like blow through a little bit more if it does come down and go somewhere more mid-range here, somewhere maybe into the 40s or even slightly lower. But Biogen is going to be really key. That's sort of the leader, and we'll see what happens with that. Gilead is one I've been bullish on, although it has been absolutely a choppy mess. I did like the earnings. I thought that their drug numbers were really good. The stock popped. It had a bit of a reversal. It stopped just short of the gap fill, and it did pull back. So I'm looking at this as possibly forming some type of an inverse head and shoulders with the left shoulder here, the head here, and the right shoulder here. But it's starting to get a little bit messy, so that pattern is a little bit less easy to play. What I would say is this, is if you are playing long, there are two key levels that you really need. There are kind of 2 to 3 key levels here that you really need to hold. And one is the low of day here, this 102.88. I've said that I thought that this stock was sort of a long as it could hold the 103 to 105 level for the next leg higher. So if you lose this 102.88, I would say you could kind of, there's no need to participate at that point. It's lost its mojo, at least for the time being, and we may want to fill the gap here. But if you do look that these lows were roughly the same, they were roughly off of 100 with slight look belows, and that area between the 98.37 and 100 has been really strong support. It has held. The numbers were good. This should get back up to the 105s, potentially to hit that range. But if we do kind of start coming back up into here again, we'll have to see if price accepts higher and does get that fill to 108, or maybe even up even higher to 110, or back to the old highs of up to 116s. It is possible that this is just consolidating here and it's going to be a launch point for higher. So that is what I'm watching with Gilead. I'm currently long. I did take some profits, but the size is not really that small, just because I don't have a lot of confidence in this pattern, because it's been super choppy. But my stop here will be roughly if it is below the 103. And I would be, looking to reload maybe down back by these lows if this does wind up rolling over even further. But I do think that the pattern here is quote unquote bullish, but within the guise of being very choppy. CELG, that also has been making lower highs, lower lows. It is coming into some important levels. The 50% Fibonacci here is key. I was really actually hoping for this to come down a little bit more steeply into the secondary trend, and also the 61.8 fib on one time frame. Roughly, another fib is on another time frame is closely around there too. I was looking for something here between 97, 96, let's just say 98 and 100 to sell some out of the money puts. There was also a breakout here around 96, so this to me was going to be the level I was looking to sell some puts into, but we got the bounce ahead of time, so it may have to roll over again to come back down into there, and you can see we have a volume distribution. I believe that selling near-dated short-term puts there would be a good long proxy. Maybe something a little bit lower in the 90s would be those puts, I think, would expire worthless on some type of a pop. But, again, also caution mode until we break the downtrend. You can see we have a confluence of moving averages and a downtrend just above us. So this could also set up for some type of a right or right out short. It's roughly where this breakdown was, roughly mid-range. So for me, if this rallies early, like next week, I'd be looking for some type of a right or right out short against the downtrend line. Roughly, if it did it Monday, it would be roughly around like 117. So if it's right or right out here, you're looking for the rollover. If it breaks, you're going to want to cover and then probably load up and just reverse the play long. So that's my thinking on CELG. Already covered Apple. Let's do Amazon. Bounced roughly where I thought it would, around the 50% fib from this low up to here, and is turning around. I think that this probably should go higher here, assuming the market stays healthy. If this does break here, look for the gap fill. I do think that would be in play. You could do that with put ratios or a put spread, or if you want to just outright short the stock. But I do think that the pattern here is it held where it should, and and if it's to stay on, I guess, course, we're roughly around the midpoint of the channel. I would be looking for it to move back up. If it does roll over, look for it for a right or right out type of a long on the channel low, or a right or right out short for a play to the channel low. That's what I think about Amazon, and that's my story. I'm sticking to it. Baba, wow, still showing a lot of weakness. It had this look below here. It did it on low volume. I was sort of hoping for it on large volume, although I did say I thought that this was a long for earnings, particularly on some type of a shake and bake. It did get it, but look where it stopped. It stopped right at the down channel, and we had a lot of sellers. These were all people who try to buy the dip up here who were now made whole and decided to just get their money out. Friday also, again, a lot of relative weakness with a kind of a harami with inside this, two bearish haramis. I would be a buyer, though, if we can clear the earnings gap high of day, which is this 89.29. So I think if you can get above there, the move would probably be to 92 and potentially to fill this gap up close to 100. I think that the company has, I know that the company has a big stock offering coming, and it's going to be in September, and they need to do something like get the stock price higher so that they can sell those shares into. So it would not surprise me to see some type of a mechanical play to try to manipulate the stock higher. That said, the IPO price was $92.70. We're below there. I do believe that's also the break of a range distribution. I think that would be a spot if you happen to be long from here to be selling into. If you want, you can try right or right out shorts against there for some type of a rollback. But my story is that anything over this earnings high of day is a long. Anything below the low here is going to be probably for a gap fill or at least for a play down a little bit lower into the 50 and 20 MA confluence. It's not huge, but I've often said I think that there are easier trades than BIIB to play. BIDU, also one of very prominent. They're the Chinese Google, or I've heard people refer to them. This roughly held this day I had talked about. We never saw it regular trading hours, but there was a gap fill here, and it got down to the 91, held to the tick, reversed. And now we're back down there and kind of just like meandering or struggling. If you're long this, you want to use this 88.61, I think, is a stop. I'm really would be looking to buy this, though, on the channel low. Like if there is some type of a rollover, I do think it could be bought somewhere close to like this 80 level, and it would probably be just because it's sold off so much for so many days. I think it would be sold. This would be a good area to maybe sell some out of the money puts into. But for a bounce. The one thing that really is disturbing me is that on a longer time frame, you can see this had been in a very defined up channel for quite some time. It looked above here. Those moves were unsustainable. But we now have a pretty confirmed break of that up channel into these reference areas, though. So this might just be like some noise. Like this was on the top. This might just be some noise on the bottom. But you can see, look where all this chop was. We are firmly below there. Everyone who is long, let me try and draw this with a rectangle. Anyone who is long from here is wrong. You can see all of this price action, all this buy the dip, and these were people who bought after this break. They're all now wrong. So I would think that any type of a move back mid-range here, which roughly is the backside of the up channel, is probably a good right or right out short at this point. And depending on where that is, it's roughly now, if it happened Monday, it would be like 209, but somewhere between this like 211 and 217 area, which was this breakdown, I think that will set up for a good right or right out type of a short if this does happen to rally. So this definitely showing a lot of relative weakness. I'm very cautious. I would be very cautious if long, but would be looking to buy the dip just for a bounce higher on some type of another flush. Like if this is starting to get steep, if this got steeper still, then I would think it would set up for a bounce. But BIDU really showing a lot of signs of weakness and breaking down. Very careful there. Facebook, Jesus, this stock is just never making it easy, right? Let me show you something. You can see it is, though, in this sort of like up channel here, and we're getting close to that up channel low. After having tagged out the up channel highs several times, it just looks like a pullback to the channel low. The stochastics are getting really oversold. We're below the lower line, and there is a lot of reference support. If you do a measured move like you did from 82.17 down to these 73.45 lows, that would roughly take us from this like 86-ish area down to 76.96, and we were roughly about there. We sort of just got there, the low of the channel, and held. It may do something like chop for a while. You can see this was very choppy for a while until it had the resolution higher. I expect it to probably do the same. I would say, though, at this I am still bullish on Facebook longer term. I'm looking for 100 longer term. I do acknowledge, though, that I think it would need news or earnings to get there at this point. And I would countenance, if you are long, you're going to probably want to look to book some profit somewhere between 80s and 81, where this breakdown took place. There may be a little bit of juice in the tank to get up to 82s, which is sort of midway of this range. But I do think between 80 and 82 is going to be a really tough area to get through, at least without earnings. And I'd be looking to lighten up and just play the range until we get until we get a little bit closer to earnings, and then we'll sort of reevaluate where we are. I do have a longer term thesis on this, but I am a trader at all times, and I'm always very mindful of stock action and price and such, and this is actually showing some relative weakness. I do think that if there is some type of a move here, I did say that I think the buy here was between 78 and 77. That has worked so far. I would countenance the buy the dip thesis in this unless we break the channel. If the channel breaks to the lower, then we're going to have to start going into some real risk management mode, and then I would think 75s and 73s are potentially on the table for a full move here. That would then set up for a good right or right out trade. If you're long this and worried, just buy some put ratios or buy some put spreads just to hedge, or on rallies up to here, sell some upside calls, just collect it and lower your cost basis a bit. But longer term bullish, short term just a little bit cautious and think it's going to be in range. A lot of that weakness has been accredited, in my view, to this Twitter move, which was an absolute shellacking. So Twitter is roughly on its trend line. It's a little bit below here. I do think that this will eventually figure its way out to bounce somewhere between 44 and 46, with 44, 58, 45 being the sweet spot. But I don't know how it's going to get there. It may need to do it on the earnings, or it may just be there may be some news or something. I do believe it'll get there, but I don't know that it won't see 36 and 34.62 before then. At these points, I do think that you can probably sell some out-of-the-money puts or buy the stock right or right out for a long for a bounce. But the stock is just washing out. There was a lot of people who bought up here who thought that we were going to see the channel top. I actually thought we had a good potential to see it, but I have been saying for a long time that Twitter needs to see back-to-back good quarters. We haven't seen that. I do think we are now sort of in this chop phase. You can see the last time we gapped down, it was just really choppy here for a while. It did have another leg down to this low. So I do think that there will be some type of price memory somewhere between here and here. But I do think the stock is going to be kind of dead money and choppy for a considerable period of time. So that's my view on Twitter. There's a lot more to cover. Let's just do a few more. IBM, that's another big one. You can see we broke into the gap here a bit. It is starting to, it did kind of have some memory. It's coming back down. I do think that IBM probably is, excuse me, it's starting to make higher lows and higher highs. So I guess it's now by the dip in IBM, right? As long as you can hold that pattern. I wouldn't be chasing up here, but I would be looking to buy if you can get in somewhere around 165 for some type of a right or right out play. That would roughly coincide, I think, by the time it got there with the 50-day moving average and also these breakout highs. So that to me would be the buy the dip spot. It is, if you're still long though, you probably want to hold it for 82s, which would be the full gap fill. And then also where this breakdown really took place. So that is my thinking with IBM. It's sort of buy the dip, but also sell the rip. Netflix. Netflix is holding up high and tight. This is really what I thought it would do. I know a lot of people have been asking me on the stream, is it a short, is it a short? And I've continued to say that I don't think so. And look where we are. We're basically pressing right up against the highs here. It's basically a pretty strong bull flag. These patterns don't always resolve higher, but my thinking until it's not, excuse me, if you are playing this from the short side, you probably want to do something like buy puts here and then sell 2 times out of the money somewhere down below here, because that would be a play sort of just back into the range. If you're playing long, you might want to be a little bit cautious though, because the 1.618 fib extension is up close to the 600. It's 596.67. It's been holding up here enough that I don't know that 20 points is going to kind of be the end of this thing. It could do an overshoot, but if I were long, and I'm currently not, I would be playing for probably holding for a move up there with a stop out below this sort of flag low, the 552. So like somewhere between 552 and 550, I think that area is the absolute must hold. You might want to put on some type of a put ratio protection if you're long, playing for that. But I mean, the stock looks bullish. I mean, it hasn't come down. There are probably still people who are still trapped short. So that is my view on Netflix. The stock has just been holding up like a champ, even given the market's downturn. It really didn't show very much weakness. It showed a lot of relative strength. I'd be careful with shorting that. Priceline. If I don't mention this stock, people flip out. It's really not one I think that most people should be playing. To me, this is really big wave ride. This is pipeline in my view. This is surfing Waimea, and I'm not talking about sandbar. I'm talking about the real deal. You know, if this stock drops $100, a lot of people will blow out their accounts. The stock did do something like have a false breakout here over the down channel, and now is gapped below the prior uptrend within, you know, sort of the pattern trend, and roughly holding lower. So I would say the 50-day, it's right on the 50. I would say if you're below the 1195.36, the stock is probably going to go lower and retest, maybe even considerably lower. But if you can kind of get over this gap day high, there might be a play for a gap fill. So that's and then it's sort of like reassess. So I would use the gap day range and this sort of low here as your references. It's right like on the 50. So anything below 1227.89, I don't really see there a need to be long. Anything below here, you know, you probably actually want to be looking for a little bit short for more of a pullback into the reference lows of the range. So that is Priceline. Expedia, on the other hand, is showing a lot of relative strength. The stock is at new all-time highs. Now, I think Expedia is doing this through a fairly clever marketing campaign with pricing. I know in the past I've been using Expedia more recently, and they usually tend to show up as the cheapest because they don't always include the tax in the pricing. Priceline does, so that Expedia always looks like it's cheaper until you go to checkout and you realize it's about the same price, sometimes even more, but it is fairly competitive. I do believe their website and their mobile app are better than Priceline's, though, so I think their technology is sort of a little better. If you're looking to play travel, you know, stick with what works with the strength. I would be a buyer of dips on this stock. I do think it is getting a little bit extended. I think it's a little bit hard to chase. But you can see we are closing over the gap high. So, you know, the stock is still long until this range is taken out. If it comes back down, then we'll be playing for the gap fill. So I do think Expedia is the better play over Priceline at the moment. Let's end on Tesla. Tesla is really, really choppy. It had a sort of inside move based on it. I mean, the day was outside, but the move was smaller than expected. I had cautioned this in after hours. You know, the stock had been up a few bucks. It initially had a spike, I think, to like close to 42, then pulled back, caught the channel low, and is now roughly hovering here. So I do think that the path of least resistance for this stock is likely higher. But I am a little bit cautious as long as we're below sort of this spike low, high, which is 238.75. So you really need to, and you can see we kind of found resistance there in regular trading hours on Friday. If we can get above those highs, I do think we will go higher to the 245 area and possibly to fill the gap to 257.70. If we do something like roll over a bit, there's probably room down to like the 200 MA. And, you know, that 225, 226 area to me is really, really critical. I had said anything below there, we would see 120. Look what we saw this day. We broke that area. We saw it very quickly. So you don't really want to see that again. This was a big body reversal day. And, you know, the stock is showing relative strength, particularly to the market, considering its range. I was bullish on it here on the breakout here. I did play it long, although I'm mostly out of it at this point. So I would say that Tesla, if you can get over this kind of consolidation high of over the 238s, it's probably going to see still higher. Anything in this range is just chop, and you're going to have to play the range accordingly. If you do lose this 220, then we are coming back down into the 205, 206, 203 to 206 range, and then to me it's really just going to be a dice, sort of shooting dice. Anyhow, that's my story for the weekend. I'm sticking to it. I hope everyone has a good Mother's Day and a great trading week ahead. Keep an eye on those levels that I mentioned. The that point range in SPY in particular is really key. Be sure to follow me on Twitter. My handle is @JustinPulitzer. Be sure to like this video if you found it useful. Comments always help. I always like you guys to help, and girls, to help me make the videos better with your comments and suggestions. And that's all for now. Cheers.